Everyone is chasing a bubble. The AI bubble, the housing bubble, the credit bubble, the stock market bubble, the retirement bubble. But looking at it this way may be the wrong approach. Because the real danger isn't that a single part of the economy is inflating, it's that every inflated piece is holding up another inflated piece. Tech spending props up GDP. Stock prices carry retirement accounts. Home prices feed household confidence. Credit cards sustain consumer spending. And government policy stands behind the asset markets. When every weak pillar leans on another weak pillar, the system can look stable right up until it starts to move. The modern economy wasn't built like a fortress. It's more like a house made of bubbles, walls, windows, doors, furniture, and an expensive kitchen remodel nobody can actually afford. From the outside, it still looks solid. But underneath, a huge portion of the structure is already damaged. It stays standing only as long as prices stay high, credit stays open, consumers stay calm, and policymakers stay ready to bail out the right people at the right time. That's not strength. That's a dependency dressed up in good branding. This isn't the first time an economy has confused rising prices with real wealth. In the 1920s, America convinced itself it had entered a new era. Electricity, automobiles, radio, mass production, the future looked unstoppable. And part of that future did arrive. Cars transformed the economy. Radio transformed communication. Factories transformed production. But even real technology can create false confidence. People start using tomorrow's promise to justify today's speculation. By the late 1920s, millions of Americans were borrowing money to buy stocks through margin buying. When prices rose, they made money faster. When prices fell, they went into debt faster. A system that looked like prosperity was quietly turning into a machine that multiplied losses. At the same time, consumer credit was reshaping everyday life. Installment plans let people buy cars, appliances, furniture, and radios without paying up front. This was sold as progress, and in some ways it was credit can smooth out spending and give earlier access to goods. But credit has a darker talent too, making weakness look like demand. A family that can't really afford a product can still buy it. A company can still announce rising sales. The economy can look lively for a while. Then the bill arrives, with interest attached. History has a sense of humor, but it also charges late fees. When the crash came in 1929, it wasn't just that stocks fell. Large parts of the economy had been built on the false assumption that prices would always rise and credit would always flow. Falling stock prices wiped out wealth. Margin calls forced sales. Banks came under pressure. Consumers cut spending. Businesses cut production. Workers lost jobs. Then the collapse fed on itself. A bubble doesn't politely stay in its own corner, it spreads through the walls into the whole structure. The same pattern showed up again in 2008. The public memory of that crisis usually starts with subprime mortgages, and that's part of the story, but the deeper story starts before that. Home prices were tied to mortgages. Mortgages were tied to Wall Street securities. Those securities were tied to bank balance sheets. Bank balance sheets were tied to credit markets, and credit markets were tied to jobs, consumption, and government bailouts. The system had turned the American home into a full-blown financial instrument, no longer just shelter, no longer just a place to raise kids, but a tradable asset, a collateral machine, a retirement plan, and a granite countertop gambling chip. While home prices climbed, everyone felt like a genius. Homeowners felt rich. Banks earned fees. Rating agencies stamped risky debt as safe. Investors bought mortgage-backed securities. Politicians praised rising home ownership. The system worked because every piece trusted the next one. Then home prices stopped rising. The asset that felt safest in the American imagination suddenly became the crack in the foundation. Once the losses started threatening the financial system, the language changed too. Ordinary borrowers had made bad decisions, while big institutions were systemically important. Homeowners got foreclosure notices, banks got bailouts. Nothing looks quite as much like a principle as moral discipline applied only to people without lobbyists. The lesson history keeps teaching is this: bubbles become dangerous once they stop being investments and start being load-bearing. A stock bubble is painful. A housing bubble is worse. A credit bubble is dangerous. But a system where stocks, housing, credit, retirement, consumption, and government policy all depend on the same, prices always go up, psychology turns into something else entirely, a political problem wearing the costume of a market cycle. Looking at today, for bubbles stand out. Bubble 1. Artificial intelligence. This is the easiest bubble to spot because it has the best marketing department. To be clear, this isn't a claim that AI is fake. Real technology can absolutely change the world and still create financial bubbles. Railroads were real. The internet was real. Housing was real. Crypto infrastructure was real enough for people to lose real money on it. The question isn't whether AI matters. The question is how much future profit is already being priced into today's valuations and who absorbs the risk if the future doesn't arrive as fast as promised. AI requires enormous spending. Chips, servers, data centers, electricity, cooling systems, land, transmission lines, engineers, cloud infrastructure. That spending counts as business investment in GDP. Put simply, when companies pour hundreds of billions into AI infrastructure, the economy can look stronger even while ordinary consumers are standing still. Today's growth numbers reflect exactly that. Consumer spending is nearly flat while business investment is doing the heavy lifting, so headline growth looks fine. The economy looks alive, but the engine has changed. It's no longer families spend because they feel confident. It's more like tech giants are building giant machine temples in the desert and calling it productivity. To be fair, some of those temples really do generate cash flow. Others mostly generate slide decks. Then there's the circular financing problem. It sounds complicated, but the idea is simple. I invest in your company. Your company then uses that money to buy services from me. Now I can tell my investors that demand for my services is rising. You can tell your investors you have powerful backers and massive infrastructure commitments. You both look bigger. Money changed hands. Headlines look impressive. Valuations can rise. But the real question remains, is this genuine outside demand, or is the ecosystem financing its own growth? That doesn't automatically mean fraud. Plenty of dangerous things in modern finance are entirely legal. That's exactly what makes them dangerous. The issue isn't whether any single deal is fake. It's whether investors can still tell organic demand apart from demand manufactured by strategic capital. When a cloud provider invests in an AI company, and that company commits to heavy spending on the provider's infrastructure in return, the accounting can be legal while the economic picture is far murkier. Growth is being reported from inside a loop. Bubble 2. Consumer credit. While the top of the economy borrows to build the future, the bottom borrows just to get through the present. Credit cards, auto loans, personal loans, and buy now, pay later plans have become the pressure valve for households squeezed by prices, rent, insurance, childcare, food, transportation, and healthcare costs. Here the story gets human. A consumer can still look healthy in the data because they're still spending. But spending doesn't always come from income. Sometimes it comes from debt. That distinction matters. If wages rise and people spend more, that's one kind of economy. If prices rise while savings shrink and people keep spending by shuffling balances between credit cards and installment plans, that's a different economy entirely. The first is prosperity. The second is exhaustion strapped to a payment plan. Buy now, pay later plans make this even harder to read because they break debt into smaller pieces. A purchase that would once have shown up clearly as credit card debt can now be split across apps, merchants, and short-term plans. Each payment looks manageable on its own. Taken together, it can turn a household budget into a minefield of small automatic withdrawals. This is where consumer confidence matters. Finance isn't just numbers, it's trust translated into behavior. When people believe tomorrow will be better, they spend, borrow, invest, move, start businesses, buy homes. When they believe tomorrow will be worse, they delay, cut back, hoard cash, avoid risk. A weakening consumer can be masked by credit for a while. But credit doesn't remove the pressure, it just stores it. The consumer hasn't collapsed. They've just restructured the pain. Bubble 3. Housing. Today's housing market isn't 2008, and that's exactly why people misread it. In 2008, the real problem was reckless mortgage lending feeding Wall Street's securitization machine. Today the pressure is different. Affordability, interest rates, undersupply in some regions, oversupply in others, and a massive lock-in effect created by years of low rates. Millions of homeowners refinanced or bought while mortgage rates were at historic lows. Many are still sitting on loans near 3%. If they sold and bought again, they'd likely trade that old loan for something closer to 6 to 7%. So they stay put not because the market is healthy, but because moving is financially punishing. Buyers are trapped too. During the pandemic, low rates made large mortgages feel manageable, and home prices climbed fast. Once rates jumped, affordability collapsed. A home that looked expensive at 3% can feel absurd at 6.5%. What people actually experience is the monthly payment, not the headline price, not the estimated value. When the monthly payment eats too much of income, demand doesn't vanish, suddenly it freezes. Buyers wait, sellers wait, transactions drop. The market stops looking like a marketplace and starts looking like a staring contest between people who can't afford reality. A frozen market can stay frozen for a long time, but it has one weak point: for sale. As long as people keep their jobs, manage their debts, and avoid major shocks, they can refuse to sell. But if unemployment rises, credit tightens, insurance costs spike, taxes climb, or household debt becomes unmanageable, some sellers lose the luxury of waiting. That's when price discovery begins, not because everyone suddenly decides homes are overpriced, but because someone, somewhere, has to sell. That comparable sale resets expectations. One discounted sale is a data point. Many discounted sales are a market. This doesn't mean a national housing crash is inevitable. If it were that simple, history wouldn't keep repeating itself. Some markets still have real supply shortages. Some households have strong balance sheets. Most mortgages are fixed rate. This isn't the same structure as 2008. But not 2008 doesn't mean safe. A different machine can still break. Today's danger is that housing is connected to everything: jobs, credit, consumer confidence, retirement wealth, local government revenue, construction employment, and the banking system. When housing weakens, it doesn't just hit real estate agents. It changes how households feel about the future. Bubble 4. The passive investing machine. This bubble works more quietly, which makes it more dangerous. Over the past few decades, passive investing has become one of the most powerful forces in the markets. Instead of picking individual stocks, millions of people now buy index funds and ETFs. That can be smart, cheaper, diversified, simple. But passive investing carries a hidden assumption. Whatever an index contains automatically becomes something ordinary savers own. When a company enters a major index, funds tracking that index generally have to buy it, not because it's cheap, not because the timing is right, just because the rulebook says so. This matters a lot when huge private companies go public at very high valuations. Private investors get early access. Founders, venture funds, sovereign wealth funds, strategic partners, and insiders build positions before ordinary people ever touch the stock. By the time the company finally goes public, the public market becomes the exit door. If index rules allow fast inclusion, passive funds can generate automatic demand. An ordinary person doesn't wake up and decide to buy an overvalued space, AI, or tech company. They just happen to own a retirement fund that tracks that index. The decision gets made at the top. The risk flows downward. None of this requires a secret boardroom deal. The most dangerous risk transfers usually happen entirely within the rules. That's exactly what people overlook. A system doesn't need to be illegal to be rigged. Private capital captures the early upside. Public capital absorbs the later cash event. Once an asset becomes large enough, complex enough, and interconnected enough, any decline turns into a market stability issue. Isn't it curious how stability suddenly becomes urgent right after insiders find the chance to sell? Now let's connect these bubbles. AI spending props up GDP growth and market optimism. Market optimism props up retirement balances and household confidence. Household confidence drives spending. Spending drives corporate profits. Profits drive valuations. Housing wealth supports borrowing, confidence, and local economies. Consumer credit keeps demand alive when income falls short. Passive funds keep buying the index as long as money keeps flowing in. And government policy stands behind the whole system, because too much wealth, too many retirements, and too many institutions are tied to asset prices. That's the house made of bubbles. Not every bubble has to pop at once. It only takes one support weakening enough to reveal how interconnected the others really are. If AI valuations fall, tech companies may cut spending and jobs. If jobs weaken, households pull back. If households pull back, consumer spending slows. If spending slows, corporate profits weaken. If profits weaken, stocks reprice. If stocks reprice, retirement accounts shrink. If confidence drops, housing demand weakens. If housing weakens, credit tightens. And when credit tightens, the economy remembers that cash and strength were never quite the same thing. This is where outside shocks come in. A fragile system doesn't need a perfect storm, it just needs one expensive surprise. An energy shock, a shipping disruption, a conflict that suddenly drives up fuel, insurance, freight, fertilizer, and food costs while consumers are already stretched thin. That's why the Strait of Hormuz matters. It's one of the world's most critical energy choke points. When a conflict threatens that route, the damage doesn't vanish once the headlines calm down. Oil can move before prices normalize. Fertilizer can move before farms recover. Supply chains can still be absorbing the cost shock long after they reopen. The real problem is this. When consumers are already leaning on credit, housing is already unaffordable, tech valuations are already stretched, and retirement savings are already tied to asset prices. Inflation doesn't need to be catastrophic. It just needs to arrive at the wrong moment. Historically, that's how fragile systems collapse. A single shock doesn't explain everything, but a single shock reveals everything. This is exactly why financial literacy matters. Not because everyone needs to become a trader, and not because financial freedom comes from predicting the next crash. It matters because if you don't understand the structure, you'll confuse the story with reality. You'll mistake a rising stock market for a healthy economy. You'll mistake a high home price for real wealth. You'll mistake credit availability for affordability. You'll mistake an index fund for something neutral. You'll assume innovation automatically justifies every valuation. And you'll assume bailout policy is random when in reality, bailouts tend to follow power. The point isn't to create panic. Panic is expensive. The point is to see clearly. A healthy system can absorb disappointment. A fragile system needs everything to keep working. Consumers have to keep spending. Employers have to keep hiring. AI companies have to keep raising and spending capital. Homeowners have to avoid forced sales. Banks have to keep lending. Index funds have to keep absorbing supply. And policymakers have to keep propping up confidence. That's a lot of has to for a system that calls itself strong. History doesn't repeat because people are confused. It repeats because incentives outlive memory. Every generation thinks its bubble is different because the story changes. Railroads, radio, housing, crypto, AI. The costumes change. The structure stays familiar: easy money, rising prices, borrowed confidence, insiders cashing out, outsiders buying in, and a public that only discovers the rules after the game's already been played. So the next time someone asks, "Where's the bubble?" look wider. The problem may not be hiding in a single market. It may be hiding in the architecture itself. A house built on credit, confidence, leverage, and the expectation of a bailout can stand for years. From the street, it can look impressive, it can even make its owners feel rich. But if the foundation isn't solid, if the house is made of bubbles, the real question isn't whether there's a crack in one room. The real question is, how much of the house is standing on air? If this video gave you a new perspective, subscribe. See you in the next video.